Let's get into a look at the markets picture over in Kenya now. As usual, recapping on the trading day that was over in Kenya. In yesterday's session, we had the Nairobi Securities Exchange. There's a main NSE 20 share index inch up 0.2% and just above 4,990 points. And that as foreign investors stream back into the bourse. Stocks continuing to register gains driven by renewed foreign support after the election. Specifically, we had Safaricom, the country's leading telecoms provider, and the most traded stock having gained 1.6% to 6 shillings 45 per share, and that ahead of its full year end of March results, which are expected to be released. It touched a 4.5-year high of 660 shillings during the session, so keep that in mind as well. On the currency front, the Kenyan shilling hit a 7-month high yesterday in the first day of trading after incoming President Uhuru Kenyatta was sworn into office in what was a pretty peaceful handover of power, and shares inched up as well. Traders saying that corporate clients saw further gains ahead for the currency, reflecting relief that the smooth political outcome of banks sold dollars as corporate demand for the U.S. currency remains subdued. Traders saying that technical analysis at this point suggests that the shilling, which is 2% stronger so far this year, could target 84 in the coming sessions. We've got it currently sitting at 84.30. Let's get into some analysis of the markets picture now with Rufus Mwanyasi. He's an independent analyst. Rufus, thanks so much for joining us this morning. Well, it seems like now that the spotlight and attention is off the political arena as such, and things have pretty much run smoothly and peacefully, investor sentiment is sitting pretty positive. Yeah, you're right. We're seeing a lot of particularly retail investors coming back into the market. And, as you said, following, the peaceful transition of power, I think most investors are really gaining confidence that, now that after the political, situation is over now. So I think most people are now kind of redeploying the money, from the relative investments. I'm talking of T-bills and T-bonds, and now, the market is shifting towards the stock market. So I guess we're likely to see even more and more, moves on the upside as more and more money start trickling into the market. Of course, we've had the financial services sector really standing in the spotlight, whether it be banks or insurance players. When it comes to the banks specifically, we've seen a report saying that Kenya's 6 largest banks increased their share of profits to nearly 2/3 of the total earnings reported by the 43 lenders in the sector for the year 2012, and that exposing a pretty wide gap between the big and small players in the industry. Just how much of a concern is that for you, and how is it influencing your investment strategy right now when it comes to managing your exposure to the banking sector? First of all, I like to say that, last year was a very good year for most banks. Rates are coming down, and the risk on the lending side was a bit contained. And as we saw, about 4 weeks ago, the results coming out, they came out, with between 30 and 40% margins on the profits. And I think, as a whole sector, I think it's very solid in terms of profitability. I mean, it increased by about 13%, about $1.2 billion. So yes, the sector is one of the strongest, relatively speaking, looking at all the sectors in the market. But however, at this particular point in time, I believe that I think the prices are a bit overstretched because a greater percentage of the market really bet on the stocks, on the banking stocks. So I think, in terms of the pricing, I think they're a bit overstretched, and we're looking at even less than 15% upside in terms of Rufus, to what extent though do you have to differentiate between those big caps and your mid-tier players? Because the likes of an equity bank, for example, was a top mover in yesterday's session. The share climbed to 35 shillings 45, with foreign investors in particular driving about 62.5% off that activity. So are you seeing value then on the lower end of the banking spectrum? Well, maybe it's something that I wanted to to say maybe the difference between the two, the big caps and the small caps within the sector, is that what we've seen is a bit, in terms of pricing, we think the big caps are a bit overstretched, and it's actually one of our recommendations is actually one of the small caps like National Bank, and some just financial stocks like Seckam, and those are two really outstanding because
they were the ones that are overlooked last year or in the recent run-up. So I guess that's where I think the market should be investing in, because when you look at the big caps, the likes of KCB and Equity, in my view, I think they're a bit of a stretch as of now. So I think in terms of positioning right now, I think people should be looking at the small cap and mid cap within the financial sector, and the likes of Seckam and National Bank of Kenya really stand out.
To what extent can we extrapolate that through to Uchumi stores as well? We had foreign investors tripling their stake in the retailer, and that really encouraging its performance on the Nairobi Stock Exchange on the back of expected earnings. What are you making of valuations on Uchumi right now?
Well, of course, we've seen a lot of participation from the foreigners, and particularly attracted by the fact that the whole mid-class expanding story, and the fact that there's the income is a big getting better for most of that class category. So I guess that's where you're seeing a lot of percentage, and in terms of percentage, you've seen it increase from about 7% to about 20% in terms of holdings for that particular stock. And I think going forward, we like to see even more and more participation, because this is a story that is actually gathering pace, and more investors are coming along. And it's only that we only have few retail stocks listed. So I think you're going to see a lot of people just piling up on that particular stock.
But that's exactly the case.
The only one.
That's exactly the case, yes. Rufus. I mean, if you're looking at Uchumi's share price, it's gained 72% in the past year. It's sitting currently at about the 22 shilling mark. So has it been running on the back of fundamentals and the fundamental story it's putting forward, or running on the back of the fact that it's the only retailer that you can actually get your hands on the NSE?
Well, as I mentioned, one of them is the fact that middle class is about 40% for this particular country. So and it's increasing, and I think that's the reason why most investors are coming in, because it actually caters for that particular group. Now, I also like to say the expectation that it's going to do well is very huge, because look, the company is on an expansion trend right now, and they're planning to roll out about 6 stores in the region, and I'm talking East African region, and in the next I think for the next 16 months. So I think that, plus also of course its fundamentals, we've seen a recovery in terms of the profitability and increase in the top line, doing very well for the last 3 years. And I think just doing a projection on that, I think we likely to see more strong profitability. Well, of course, they had a bit of a dip, for the 6 months, year. I mean, for the half-year results ending December last year. But I think that's just a short-term dip. But I think in the long term, I think this is a stock that is on a strong rebound, and I think going forward is going to serve well for investors who are betting on it.
It's not all rosy on the NSE. We had Kenyan Cobalt's share price being hit back yesterday. It plummeted to a 15-month low on the first day of trading since the company announced a 6 billion shilling loss on Monday's session. What's your view on Kenyan Cobalt, Rufus?
Well, I think there's a lot of negative sentiment surrounding that stock at this particular time, and I know there's a one-off legal settlement that they had to settle with the London court, and I think that really put a big dent on their profitability. And going forward, I think it might take time, because as we speak right now, they've been overtaken in terms of market share. I think they should be doing less than 20% right now, compared to about 2 years ago when they're leading by about 25%. Going forward, I think I like to see, just to correct some of the mistakes they made on the hedging side of the business, and maybe they need to correct that, and to perhaps maybe seek more other partners. You remember there was the deal that didn't go through with Puma, and they were really betting on that money coming through to help them on the expansion strategy. But right now, I think the second thing I'd like to see is for them look out for other partners who can bring in more capital. Or if that doesn't work out, I'd like to see them do a rights issue, so that they get the money they need to really go out into the market. And if that doesn't happen, I don't really see them coming through. And because of that, I don't think the price will turn around for now. But as of now, I think the price is still going to come down.